Today we're going to be doing this video walking along beautiful Biscayne Bay. As you guys can see behind me, we are over here at the Haulover Park and Marina today, and I'm all the way at the south end of the islands. I'm going to walk around this area because it's just so beautiful, guys, with the water and stuff here, and just want to change it up a little bit, get out of the neighborhood, get over by the water. It's so nice. One big question, and really a big complaint from a lot of people who would like to buy a home these days, is that builders don't really build starter homes anymore. That's sort of true and sort of not true, because when you look at the average cost of these new properties that are being sold, a lot of them are pretty close to $500,000 these days. But in reality, they're not really built to $500,000 standards. It's just that that's what the developer's cost is, plus the profit that they require in order to stay in business and operate, and you as the end user end up paying for, them to spend their time building the property, the cost of supplies that have gone up quite a bit since inflation has been roaring since the beginning of this year, and things like that. Technically, the homes being built are starter homes, but the prices are not. And one interesting thing about that is because Fannie Mae is predicting 2023 to be a horrible year for the housing market, they believe that home sales are going to fall to about 4.4 million next year. And to put that into perspective, they're expecting by the end of this year that we see 5.6 million home sales. That's like 1.2 million less sales that they're anticipating to come next year, but still quite high if you ask me. And the main reason that Fannie Mae is predicting such a slowdown is, of course, interest rates, because they're saying that the economy hasn't even fully felt the entire effect of these interest rate hikes, and that's something I agree with and something that I've been saying on the channel here for the last couple of months. And one interesting dynamic that could come from this is because less and less people are starting to list their homes for sale now when you're talking about existing homes. One thing that could happen into 2023 is more builders starting to decide to cater to first-time home buyers because there's less available inventory from would-be sellers who would list their home on the market right now. So there's a possibility, Fannie Mae thinks, that in 2023 we could see home builders start to cater more towards the starter home market once again, like they did many decades ago. So that'll be interesting to see if the home building sector can actually come in and save the day for the housing market, particularly when it comes to first-time home buyers. Check this out, guys. There's a ton of little fish in there. That's why I wanted to come over here today. Just check out some different things. Plus, we're right over here by the Haulover Inlet. Who knows what we might see over here. It's always something interesting going on. Now, according to HUD, there was a new report stating that new construction home sales are up 7.5% as of October 2022 from 2021. However, the interesting thing about this is that this data could be completely wrong, because they estimate that there could be a data error rate as much as 19%, guys. So it could actually be down, but right now it looks like it's up with the preliminary data in. But the reason why this is interesting is because it kind of ties directly in with what we just talked about, that if in fact new construction home sales are up year over year, then that could already be a leading indicator that more home buyers are going to be turning towards builders looking for a brand new home versus home sellers that would be listing their homes on the market due to less sellers listing right now. So that'll be an interesting trend to look for into 2023 and see just how much of this materializes, and if home builders will in fact start focusing more on first-time home buyers and building maybe smaller, more affordable starter homes. I think we could all agree that there's probably a huge demand for smaller, maybe 1,300 square foot homes that are in the $250,000 price range. And even though that's still expensive for a home that small, it's a hell of a lot better than the $500,000 brand new home that a lot of people are looking at right now. But who knows, maybe the prices for these brand new homes will actually come down, because right now the average price for a brand new home sold is about $544,000 nationwide. So that is very expensive still. And at the end of October, there was about 470,000 new construction homes on the market right now. And that number represents about a 9-month supply at the current rate that they're being sold. So that's still pretty high. You know, if you just take that as the dynamics of the entire real estate market, that's a far better outlook in terms of inventory than the market overall, where inventory is still quite a bit down, and at best some areas might have like 3 to 4 months worth of inventory right now. Got the boats going by, and I can't even escape the landscapers, even over by the marina. Another thing that's going on right now is a lot of employees are basically in desperate need of a raise from their employers. And one of the most recent trends that's going on in the job market is people are getting to the point where they need to start applying for new jobs if they want to get a raise, because a lot of times people will go to their employer, ask for the raise, they refuse to give it, or the raise that they give is just not what they were hoping for, or it's just not enough. It's putting employees into this very awkward situation where if you want to make more money, you're forced to start looking for a new job and apply at new places. And what's going on is employees are starting to use this as leverage to basically blackmail their current employers into giving them a raise, which is kind of insane that it's coming down to this, that you need to actually find a job somewhere else and prove that you have a job offer on the table for your current employer to give you a raise. This is why there's no such thing as loyalty from employees anymore. Employees don't have an incentive to stay loyal anywhere, and I don't blame them. If I didn't get a raise that I was looking for, I'd be looking to jump ship as well. I changed jobs many times over the years when I actually worked different jobs. I mean, I probably wouldn't work a single job more than roughly a year until I would change jobs into something else. But like I said, it makes the situation pretty awkward no matter what you do from there, because think about this. You have to blackmail your current employer into giving you a raise, and okay, they say yes, great. They're gonna give you the raise, you don't actually have to switch jobs, but now you've basically blacklisted yourself from the other company that gave you the job offer to begin with, and if you end up needing a job from them in the future, well, you just kind of burned that bridge because you wasted all their time and their HR resources to apply for a job, and you actually got the job offer and ended up not taking it. So that's not really a good look for anyone. Not everyone who's looking for a new job only wants a raise. They're also sick of the people that they work with, essentially, and are looking for a change of environment. And obviously those people are going to be the ones who are highly likely to accept the new job offer that comes in. But the people who end up staying at their current job because the manager caved and gave them the raise that they were looking for, guess who's probably going to be first on the chopping block now that so many companies are doing layoff? You guessed it. Yeah. Why? Well, because you blackmailed your employer into giving you a raise. So obviously they're not going to be looking at you from a very favorable point of view. So personally, I don't know why anyone would do this and actually stick with the company that they're at. I think that kind of puts yourself in a very vulnerable position. I feel like if you're going to be out looking for new jobs anyways, and you actually get offered a new position somewhere, making more money, I mean, if it were me, I would just take it, you know, like, I'm not messing around. I'm applying for a new job so I can actually get one, not to use it as leverage with my current employer. So let me know what you guys think about that. I've never actually done anything like this before because I haven't had an actual job in many years now, but I could see why people would be doing this. I just think that it's sad that it comes down to people need to be, you know, running around behind their employer's back and trying to get a new job just to get a raise. The Mortgage Bankers Association is predicting that by the end of 2023, then we're finally going to start seeing mortgage rates come down. Their predictions are, they're thinking that 30-year mortgage rates by the end of 2023 are going to be 5.4%, and by the end of 2024, they're going to be down to 4.5%. Now, I don't know if that's going to happen or not. That's a pretty long ways into the future to kind of guess where they're going to be at a year from now, but they're basically counting on the fact that the Fed is going to pivot their monetary policy at the very beginning of 2023, and that's pretty much how they arrived at this conclusion. However, I think they're being very optimistic because one thing, like we talked about many times before, is even if the Fed does pivot, that doesn't mean rates are going to go down. It just means they're not going to go up as fast as they have been. So a Fed pivot coming at the beginning of 2023, I don't think is going to do much for the mortgage industry, especially into next year. I think mortgage interest rates are still going to rise, at least for the first half of next year. And if they come down, they're going to come down much slower than they went up. But who knows? Maybe that won't happen. Maybe the economy by the second half of next year will already be in such bad shape that you might see the rates coming back down, trying to get people into properties because the housing market is suffering. But think about this, guys. Say you get to the end of 2023 and the rates are 5.4%, like they're saying. It's about 1.5 points lower than where they're at right now. But home prices, only came down by maybe 10% in your area. Is that going to be enough still to get you out there to buy a home? Because I think for many people, it still won't be. Because another interesting dynamic we've been seeing recently is supposedly, this is the third week in a row that mortgage interest rates have gone down slightly, but yet the demand for mortgages is still continuing to fall with these decreases in mortgage interest rates. So these rates falling down by tiny little percentages are doing nothing to get people back into the market to buy a home because it's simply just still too expensive. And that's why I keep going over this dynamic of as long as people can't afford the monthly payments and inflation is eating up a large chunk of people's budgets, they're not going to be buying, And I think a lot of you out there who watch feel the same way. You feel like it's still way too expensive and, now there's a lot of uncertainty in the job market with all the layoffs going on, that it's probably better to just wait this out a little while and see what happens. And I think that's pretty much the smartest thing to do right now. Because at the end of this report, they're telling people, well, if you can't wait, the best thing to do is just to jump into an adjustable rate mortgage. Terrible advice, like we've talked about before. That's one of the last things you want to do, because if you do that right now, the odds of you being able to refinance over the next few years are very low. Now here's a story for a lot of people who think I'm unrealistic on what's happening with the market, because I'm always talking about the home prices coming down and it's going to crash and blah, 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 blah. But yet people write me saying, well, prices are still going up in my area. There's still bidding wars and all these things happening. Well, this segment is for you guys, because there are places where prices are actually still going up, even as the market is suffering in many other places. And I have no problem admitting that or letting you know about it here on the channel, because I think that the more everybody knows, then the smarter we're all going to become, and we're all going to be able to make the best decisions when it comes to real estate for our own areas and our own local markets. So it's important to know where prices are actually still holding strong and even actually going up. So check this out. In Albany, New York, as of October this year, home prices are up 11.2% year over year. As well as Bridgeport, Connecticut, home price per square foot is up 7.5% year over year in this area. And in McAllen, Texas, home prices are up 18.7% year over year. So those are pretty big increases. Those are just a few areas to name a few. So just because the market is starting to go down overall as a median average across the United States and in many locales doesn't mean that's the case everywhere. But one of the reasons why these areas are still booming is because the affordability there is still very high, guys. People can afford to buy homes there even with these high interest rates, because these areas have not seen home prices explode like so many areas across the country have. So this is what we talk about all the time. When you have housing that still is affordable based on what the locals make for their average wages, you're still going to see a strong housing market. And these areas reflect that. There's also some places in the Midwest that are still holding up really strong, Milwaukee being one of them. So yeah, is it totally over? Is it totally doom and gloom everywhere? Absolutely not. There are still places where the market could actually go up during a housing crash. And essentially what it comes down to is, even though that interest rates are higher, it has a lower impact on people's monthly payment because the price to buy these properties is so much lower than all these other areas that are seeing the home prices drop now. And you know another area that defies logic? Right here where I'm standing, guys, in Miami, South Florida, Broward County, these areas are defying all odds when it comes to this housing crash, because this area has appreciated pretty much more than anywhere else in the country. Miami has led the nation in this housing price run up, along with Tampa, Florida as well. And to put this into perspective, guys, the median sale price for a single family home in Miami as of October is at $575,000. And just a year ago, that number was $490,000. For condos, right now it's at $388,000 median selling price, and a year ago it was at $326,000. Single family home prices are up 17% year over year, and condo prices are up 20% year over year in Miami, which is staggering. And why is this happening? What we talked about just a minute ago is that the locals' wages still are able to support the home price growth in the area, which sustains the market, okay? That's usually the case in many areas where this dynamic is happening. But South Florida is different, guys, because in October, 40% of the homes sold in all of South Florida were cash deals. That's almost half. And that is far above the national average, which is about 24% of homes are sold cash nationwide. So we are quite a bit above what the national average is when it comes to the amount of homes being sold to cash buyers. And just like we talked about in a couple of recent videos, who are these cash buyers? Well, they're still investors, institutional investors, regular investors, and even investors from outside the country, guys. I mean, probably almost half of the deals I've ever done were cash deals as well, because people just come here from all over the world, from all over the country. They buy up our real estate, many times pay cash, and don't even blink an eye. So it doesn't really matter if the locals' wages are enough to keep up with the home prices here, because with or without that dynamic present, it seems like the market here just continues to go up. And one thing that's quite different this time around in South Florida versus the last housing crash is last time we had a ton of inventory, guys. I remember during the last housing crash, at some point we had like 30 months of housing supply on the market here, which is an amazingly high amount. That's 2+ years of inventory. And combine that with the subprime mortgage crisis, home prices here plummeted. You know, went down 50% during the last crash. And a lot of people ask me all the time, you know, hey, I want to move down there. Do you think I should wait, or you think I should buy now, or whatever? And here is such a different market than everywhere else. And even me, you know, being here for so long, it's even hard for me to predict, guys, because on the one hand, we have this dynamic where you have all these cash buyers just coming in and paying these insane prices like you guys see on all my walks. I put up the listings that we walk by. You know, probably 80-90% of these homes we're looking at are short-term flips. Homes that people bought a year ago, whether it was cash or not, and turn around asking $500,000 to $1 million more and in just 12 months later. It is insanity. So how much longer can this really go on, I ask myself, and my gut says not a whole lot longer. And I think probably a lot of you agree with me, but there's no telling just how much more money could pour into the area over the next several years either. So that's an unknown, but it's also unknown how bad the economy is going to crash in 2023. It doesn't matter how bad this recession is going to get, because remember, this recession is going to be global. It's not going to be just local to the US. So I think it completely hinges on how bad the recession gets if this, you know, party can continue going here in South Florida. Because if we don't get affected too much by the coming recession and it's not as bad as it looks like it's going to be, then I think, yes, the party can keep going and the prices here are still going to go up even while they're coming down in other areas, which pretty much defies logic. But basically the idea here is, guys, that people who have a lot of money can weather this storm, and they're not going to care if home prices are up or down, because at the end of the day, when you have 40% cash buyers, they're looking for an asset to put that cash into that isn't going to be completely robbed by inflation. So I think that's what's really driving the market dynamics down here and makes it such a hard market to predict or call the future on. So to answer your question, if anybody is looking to buy down here, I think it's a 50-50 shot, right? You have a 50% chance of home prices still going slightly up again next year, because the prediction in this article is that home prices in South Florida are going to completely slow down but still go up by 4%. So that is not a huge amount of appreciation like we have seen, but it's still above the average that we saw in normal times. You know, in normal years, it's like 3 to 5%. That's right in the middle. So 4% appreciation next year, when the rest of the market is crashing, or at least half of the parts of the US is crashing and half of the world is crashing, that's pretty good. And that could spur people to park even more of their money here. But I think if this recession continues to get worse, the real estate bubble in China bursts, and worldwide every country starts seeing recessions and problems, then I think the party is going to come to an end, because these people are also going to be hurting in their home countries. You know, a lot of these cash buyers are foreign investors here, and they might be looking to hunker down as well and not be investing in anything when times are really uncertain. So that could be the wild card in all of this. I think it's going to take basically a strong recession / depression to take down the market here in South Florida. And I wish that wasn't the case, but that's just kind of the way things are looking right now. So I wanted to put that out there. But that doesn't mean that I don't think the housing market's going to crash in all these other areas where it's basically set to. I think places like Tampa could see a much larger correction than Miami, for example. And of course, places like Phoenix and Austin, Texas, and Boise, Idaho, these largely overheated markets that have kind of lost their luster now that the pandemic is largely over. We got the best of all worlds down here in South Florida, guys. We had the pandemic run up from people moving here from different parts of the country and still continuing to receive all that foreign investment. So we have been hit from all angles here, and that's why home prices in Miami and in South Florida are up like 50% in just a couple of years. It's insanity. If you guys enjoyed this video, make sure you click the bell notification down below. YouTube will alert you every time I put out a new video. And if you don't want to wait, check out my next video on the screen right over here, and I'll see you guys in the next one.